Good morning, everybody. Time again to do another video. So I'm doing it on Thursday this week again because tomorrow I will be at an economic outlooks symposium or meeting or whatever, where I think the keynote speaker is the chair from the Fed in San Francisco. So hopefully there's some good information from that, and maybe I'll be able to make a video from it next week. But for this week, I want to talk about how taxes are calculated versus cash flow. So this is an issue that I get some confusion on from a lot of clients because they feel like, well, if I didn't get the cash, why do I have to pay taxes on it? And so I really want to try to explain this a little bit better, because cash flow does not equal taxes. And taxes are paid on a paper profit, while cash flow is what's available in your bank account, right? So the best way to really describe this is to use a retail store. And that's a retail store is very difficult because the cash flow cycle does not equal taxes, but it's extreme enough to really paint the picture. And so the same thing can happen in pretty much any type of business, whether you're service oriented or like lawn care or a doctor's office or anything. Has a similar situation, but it's usually less extreme in service oriented businesses versus retail type businesses. So in a retail business, your cash flow cycle is you sell inventory and you make revenue, and then you use that revenue to buy more inventory so that you can then in turn sell that inventory, right? Now, hopefully, when you sell that inventory, you're selling it at some sort of markup to make your profit, right? And then the idea is that that profit would hopefully come to you in some form down the road. But usually what happens is we're growing. And so what happens is we buy $50,000 of inventory that we sell for $100,000. Then we buy $100,000 of inventory that we then sell for $200,000. Then we buy $200,000 of inventory and sell it for $400,000. And so your cash flow is instantly going right back into the business. But every time you sell that inventory at a profit, that creates a paper profit, even though you're not actually getting the cash. So like when I said you buy $50,000 of inventory and sell it for $100,000, you have a $50,000 profit that you now owe taxes on. But you don't have any of that cash because you used that $100,000 to then buy $100,000 of inventory. So that then you then sold for $200,000. So now you have a $150,000 profit that you owe taxes on. But then you use that $200,000 to buy $400,000 of inventory. So still no cash in your pocket, but you owe taxes on $150,000 in profit. And this is how the cycle goes. And so typically what happens is in a growth phase, a lot of times growth is leveraged through debt. And that's why we call, in the business world, we call debt leverage, because you leverage your growth by taking out long-term or short-term debt, credit card debt, or you take out a second mortgage on your home or something, right? Like you facilitate this growth through debt. That's usually how it works in larger businesses. So, and then what happens is at some point you plateau. And when you plateau, now you buy $50,000 of inventory, sell for $100,000, buy $50,000 of inventory, sell for $100,000. So now at that point, when you plateau, then you're able to start reaping the benefits of your hard work. Then at some point, you're going to start to decline if you don't constantly adjust for the market, right? And so that's kind of like, so your Walmarts, your Fortune 500s, your Walmarts, your railroad companies, big Fortune 500 companies typically pay good dividends because they're in that plateau phase. And they're just trying to adjust for the market to stay in that plateau phase. I read an article this morning that Walmart is closing down like 25 stores in several states because, you know, they're divesting the stores that aren't making a profit. And it's because they're in this plateau level, and now they're starting to hit the decline level because the market has changed. And so now they're trying to do things to prevent that decline, right? So but typically all my clients, we're in a growth phase. We're building our businesses. And so like I said, the point is really easy to show in a retail company, but what about like a service industry company, a fitness company, or a doctor's office, or even me, like a CPA office, where we just provide services? Well, we have expenses too. We don't have to buy inventory, but to facilitate growth, we're still spending money that we're not necessarily getting to keep that profit. Like you've increased marketing and advertising, you have to buy more equipment. You have to, you're spending more money in growing your business in different ways. And like I've added staff. Well, by adding staff, that results in me having to buy more software licenses. That's expensive. So I'm not necessarily reaping the benefit of that profit. And now the flip side of that is a lot of times, another great example of why cash flow doesn't equal taxes is buying equipment. And so we go out and let's say we buy a car, and we're writing that car off as a business expense. And so what happens is we go out, and if you pay cash for it, or if you take out a loan on it, you put a down payment on it. And so you have a large cash outflow when you buy this vehicle. Well, if you sold $50,000 worth of services, and then you take that $50,000 and you buy a vehicle for $50,000, you're out $50,000 in cash. Your profit went straight into your vehicle. But even though we're writing that vehicle off as a business expense, we have to take the depreciation of that vehicle over 5 years. Now, there are nuances in tax code and stuff, things that we can talk about, how we can accelerate that depreciation and stuff, but this is back of the napkin, like trying to understand how things work. So we buy that car, we spent $50,000 of our profit on that car, but now that car is written off over 5 years. So we only get to take $10,000 of an expense each year for 5 years. So even though we're out $50,000 today, we only get to record and take a $10,000 expense. And so these are great examples of why taxes are paid on paper profit and not on actual cash flow. What usually happens is, okay, now we're in the S Corp world. 99% of my clients are S Corps. Maybe a few partnerships that flow into S Corps, or you're waiting to build up your business to become an S Corp. But like 99% of my clients are S Corps. So what happens is that's a pass-through entity. And I've done another video on how S Corps are taxed. It passes through to your individual taxes, right? But the way it works is we say, okay, we have paper revenue, which is usually an actual cash flow line. We have paper revenue, which is, like I said, typically deposits into your bank account. So there's actual cash transaction that happens there. And then we have typically cash expenses, such as buying fuel for my car, that marketing expense, software expense, whatever it is, right? Equipment. Then I have those actual cash flow expenses that equal a paper, then come down to our net profit or net income. Well, one of those things that we might be throwing in there is depreciation, because you bought a $100,000 vehicle, or you bought some other equipment. Maybe you bought fitness equipment. Maybe you did some other things, right? And so then you say, okay, well, this is my paper profit, but you might have already spent the cash. And so then we say, okay, well, let's say your paper profit is $100,000, but you only have $50,000 in the bank because you bought a vehicle. Well, that $100,000 is going to pass to you individually and onto your 1040, and that's where you're going to calculate and pay the taxes on it. Well, that might mean you owe $20,000 in taxes on that $100,000 profit, even though you only have $50,000 in cash. So these are just as you run your business, you have to understand that the cash flow cycle is different than your tax calculation cycle. And so just be, and then what can happen is okay, let's say you get into a partnership or you bring in investors into your business or whatever as you're growing. Well, then what typically happens is when you're a single member LLC, all the money in the bank is yours. Well, now you've added partners. Now all the money in the bank account isn't yours. You owe it equal percentages or whatever your partnership agreement says to the other partner. So you might have $100,000 profit at the end of the day with $50,000 in cash in the bank. Well, if you have a 50-50 partner, you're going to take $50,000. He's going to take $50,000 that you owe taxes on your individual tax return. But then that $50,000 left in the bank, how are you going to divide that up to help pay for the taxes that are generated? And so typically you're each going to take maybe like $10,000 each because you want to leave $30,000 in the bank to cover future growth and future expenses. You don't want to spend all your money at once. And so now you might have to pay tax on $50,000, but you only got a $10,000 dividend. That may or may not cover all your taxes. So this is something you have to think about, that as you grow, you should be setting money aside to help cover your taxes. I recommend an investment account, put some money in the stock market, because that's the best way to do it. And I've done lots of videos on that too. So that's just kind of what I'm trying to say is there is a big difference, or there can be a big difference between cash flow that you receive personally as your profit versus what you're paying taxes on. And it doesn't matter if you're a retail company where it's more extreme, or if you're in a service industry company where it's less extreme, there's going to be a difference between what you owe taxes on and what you're actually getting cash for. So hopefully that helps explain things. That's one of the reasons why we get aggressive on business expenses, is to try to bridge that gap. But you have to keep that in mind, that as you're running your business, you do have to plan for taxes in some way. Anyway, hope that helps everybody to better understand. Until next week.